Thanks so much to everyone for joining today. We just wanted to give people a couple minutes to filter in past the top of the hour. Really appreciate everyone taking the time to be here with us. We're excited to host the session as part of Utila's broader stablecoin webinar series, where we're looking to bring together operators, investors, and builders for practical conversations about building and scaling companies within the stablecoin ecosystem. My name's Josh Weiss. I'll be moderating the panel today. I work as the head of sales at Utila, based in New York City. I've been with the company for just over a year and a half. Super brief background about Utila. We're an institutional grade wallet provider and digital asset operations platform for companies building within the stablecoin ecosystem. We operate as an infrastructure provider with both a UI and API and enable businesses to manage multi-chain, multi-asset wallets in one platform. We have many, I would say, value additive functionalities for these types of businesses, including configurable transaction policies, embedded compliance integrations, gas management, yield, global on and off ramp connectivity, and much, much more. So really by consolidating all of these different capabilities, we abstract away the operational complexities and security complexities that teams face as they scale and really allow them to focus their efforts more on product development and execution. Today, we support around 275 customers. We're processing more than $25 billion per month through our infrastructure. Over the past couple of years, we've really seen stablecoins move from being much more experimental to really truly mission critical for many types of businesses, powering cross-border payments, real-time settlement, treasury operations, and much, much more. And as this adoption continues to accelerate globally and new innovative businesses emerge, topics like company formation, fundraising, and building long-term sustainable business models are becoming more important than ever. And that's exactly what today's session is going to focus on: fundraising for seed and Series A companies building in this ecosystem. We're joined today by two very experienced investors for this conversation. We have Anil here from Haymaker Ventures and Finn here from Haymaker Ventures, both of whom have spent significant time evaluating infrastructure, payments, and other financial primitives in the space. We want this to be a conversational session. We want to keep it highly relevant for everyone in the audience. So please feel free, as we're progressing in the conversation, to drop any questions into the public chat at any point. We'll do our best to get to them right away, or we'll look to weave them into the discussion and hopefully leave some time for Q&A at the end. So with that, I'll hand it over to Anil and to Finn just to give a brief introduction about themselves and to get us started with today's discussion.
Happy to start. Thanks for inviting me. Lovely to see you all. So I'm a general partner at Haymaker Ventures. We're a global early stage investor focused on blockchain, with in particular two big themes: one around infrastructure software, AI, decentralized compute, decentralized data, and the other everything in and about the stablecoin value chain. That's my baby. Personally, I've been investing and operating within payments the last 14 years. Up until 2021, that was all in TradFi with Google Wallet and then PayPal. And then I had been making some investments at Haymaker Ventures in institutional grade blockchain software companies, and then made the switch to joining my partner Richard on our second fund in Fabric, which was a 2021 fund. We're based in London, Luxembourg, but operate globally.
Hi, Finn Upham. I'm managing partner at Haymaker Ventures. We focus on early stage fintech globally, mostly in the US though. I've been doing fintech for about 16 years, spent about a decade at Thiel Capital, which is Peter Thiel's family office, focused on early stage fintech from about 2009 to 2018. Then started Haymaker in 21. And we primarily do seed and A rounds. I think we focus on some of the same areas as Anil, maybe a little bit broader in fintech, but overlapping a lot of crypto and sort of stablecoin blockchain as well.
All right, cool. Thanks, guys. So let's dive in. What excites you most right now about the stablecoin ecosystem, especially among projects that are moving beyond the initial phases of their launch and into real scale?
I'll take a crack at it because I'm sure since it's an area you focus on exclusively, you'll probably have a lot to say. Um, I'd say obviously the biggest theme in the last couple of years has been the institutionalization of sort of I guess, do you want to discuss like stablecoin specifically or sort of crypto or blockchain more generally?
Yeah, I'd say the focus is stable coins, but obviously crypto adjacent, right? So
Yep. So I mean, stablecoin, like from obviously the Genius Act to just I think on Friday the OCC gave at least signaled the green light on 5 banking licenses for companies like Circle and and Ripple, for example, which is like a big deal. Like they've gone from outsider weird products to very much core legalized institutional grade structures, or at least potentially institutional grade structures. And that's a big deal because it allows a lot of governments, banks, and big companies to jump on board, which I don't think they could have done before. The cross-border thing, I think, is like, in a way, the thing that was always possible that hasn't changed. And even though that's the fastest growth area, I feel like the even more promising areas that I would say are just revving up are the parts that are internal to the traditional financial systems within like banks and within government payments within sort of like more like treasury departments. I don't think a treasury department would have touched stablecoin with a 10-foot pole 4 years ago, 3 years ago. And I think that's the biggest change recently, and I think there's huge opportunities there.
Yeah, I think those are all great points. And obviously excitement is both at the macro level and at the micro level. For us in the fund, it's no better than seeing several of our portfolio companies, 10x, 15x, 20x volumes, right? That's a sign of 2025 being real traction, right, for the first time. And like several of our portfolio companies raising, further funds. That's also sort of a validation, and that exactly comes from, I mean, I think what Phil said, which is that institutional adoption, regulation opening the way. And I think it was also spot on to say, these use cases have moved beyond the obvious 10x, 100x, whatever it is, improvements in remittances. And we're now seeing teams that are really focusing on, on the surface, micro use cases, but actually they're like pretty big in terms of a TAM. Things like pre-funding within merchant acceptance, within capital markets, supply chain payments, even local stables. I mean, obviously US dollar dominates, but that just is not a reflection of what the FX markets are. And we're seeing a significant amount of on-chain FX evolve. We're
I see a lot of
seeing
FX.
stable coins being used not just for payments, but as the fundamental building block for real world assets. So you decompose the money market funds into the atomic unit. We're seeing stable coins being used as a core unit for on-chain banking, where effectively you put the stables in a vault and you generate some yield for your on-chain customers. And we're seeing, I think, the consolidation of um, institutional adoption, or looking at least at things that were only a year ago deemed as extremely DeFi, right? So like all the efforts that Morpho are doing on the enterprise, where they manage all their underlying custody or liquidity, talking to all the neobanks. Those banks, don't want to risk their banking licenses by themselves offering hyperliquid perps, but damn well they'll talk to Morpho. And so I think that consolidation of the two worlds is also another interesting trend.
If I may, like, building on Anil, your point right there, if all stablecoins do, and I think this is exactly your point, if all stablecoins do is make it a little bit faster, a little bit cheaper, a little bit easier to do like whatever, right? To like do a transaction, to send money, to do cross-border something, to do FX. FX is the perfect example. I think the improvements for stablecoin for FX are completely marginal. They're nice, they're a little bit cheaper, they're a little bit faster, but it's not a fundamental change. I think stablecoins have the opportunity to do something more than just make them cheaper, faster, better, but actually do something where new opportunities, new options fundamental changes to the banking and financial systems are enabled by stablecoin. And if you want to say what I'm most excited about, it's that. And I think that really, if I had to say the key thing there is, will people be buying things with stablecoin? Will they be holding their money with stablecoin? And I say that because if people hold their money in stablecoin and are able to do a direct credit card to store, stablecoin to store transaction, it will change the way the US banking system and the global banking system functions. This entire fractional banking system we have, where banks take all your money, pay you 25 to 50 bips, and invest that money in 4%, mortgage loans, like that's gone. Like that's gone because now I can hold money in stablecoin, make the 4% myself, and it changes the entire intermediary relationships of banks to global finance. If that happens, and that's only one of many examples of sort of more foundational changes, not only will consumers get much better options, but like, the vampire squid that Goldman Sachs was called will go away. Now, whether or not the government allows that to happen with all the entrenched interests of financial tradfi is a really interesting question. Right now, I don't know how they stop it.
Thanks. Yeah, I'd say that's something at Utila that we're seeing a lot of demand for as well. Is in many jurisdictions, custody for banks, for example, has already been a thing, and now they're looking to be productive of those assets. So I
Like if
think
you
that's a
don't
trend.
hold your money in a bank, it's like everything changes, right? Like it's just like it's everything. Like it's the entire financial system, the entire government control of the financial system is predicated upon that assumption.
100%.
Yeah, I mean, I think that's probably why that despite all the positive regulation changes, there's still an immense banking lobby in the US that are scared shitless about access to Fed rails, um, for crypto companies to access Fed rails, and which is why still it's incredibly difficult to get transaction banking as a crypto company around the world, full stop. And why banks like Cross River are one of the few, or lead, one of the few that do it. And even a company like Circle, that has reserves with tier one banks, does their transaction banking via Cross River. I mean, it's just an anomaly, and why they're seeking their banking charter themselves to access T plus zero Fed fund conversion rates. It is still a concern in the industry that we still have this sort of fragile infrastructure for crypto on or for banking on chain, or payments on chain.
Thanks, guys. So we're coming towards the end of the year. Now's the time companies are planning for 2026 strategy, right? When you're evaluating a company from the investor perspective, what do you want to see in a go-to-market strategy when we're thinking about a stablecoin or a stablecoin infrastructure play? Any insights you guys could share with the audience here?
Yeah, I mean, I think the low-hanging fruits of, I mean, we've referred to this before of hey, we'll just do something faster, 10x, cut out the intermediary. It's really obvious that those opportunities, to me, are probably going to be owned by classic fintechs with all the large distribution that already have in terms of their customer base, whether it's businesses or consumers. Yes, there will be some new starters breaking through, but probably not as many as we think, and that actually the fintechs will be served by infrastructure as a service companies who are blockchain based to help them deliver those solutions. So I think if we assume that those sort of low hanging fruit opportunities are not there, we really have to go and back teams that I think have some very unique access to their chosen customer or their chosen target audience, that is both sort of quite unique and can scale. So it's arguably going to come from an understanding of where how the value chain works, and where there's still some incredible pain points where they just have that network and access to solve. That's clearly number one that differentiates and what I look for in go to market. The other is, if you're in Series A, you're sort of needing to already demonstrate, like already scaled, that like the bar has gone up considerably. Whether it's 4 million ARR, whatever the magic number is, it's a lot higher than it was a couple of years ago, and that has to have doubled or tripled over the last years. And then I think investors are also probably looking at the economics of those users as well, much more. So, okay, there are many stablecoin orchestration plays that arguably will commoditize, take rates, especially with US dollar related stablecoin movements, i.e., outside of an FX play, will compress. The margins will compress. How easy is it, to manage churn? What kind of minimum guarantees of volumes do you have from your customer, or can you demonstrate steady state of flow of volume from your customer? Yeah, so investors are being a little bit more sensitive to, in a positive way, but a little bit more sensitive now that we've moved out of the kind of like the easy low hanging fruit grab.
Yeah, totally. So I agree with all of that. I'd say like uh, the problem with fintech, because I'm a fintech investor, so I'll generalize for a moment and then apply that generalization to stablecoin. The problem with fintech has always been the accusation that it's just a regulatory hack. That most non-bank companies just do some kind of regulatory arb. They then like compete against banks. The banks can't compete with them in some way, and then they're able to like build some marginally valuable but not incredibly valuable regulatory arb. Because if they get too big, they get regulated, and then there's no longer any advantage, or the arb goes away. That's kind of been the big critique of fintech for years. It's largely like it's not untrue. There's a lot of truth to it, and I'd say that like this is especially true in the early stages of any kind of change, like when you like first got digital transactions and all of a sudden these like you could do something online, so you could go without a bank and you could go like get a mortgage, and or you could go and like refi your student loans, and it was like better than banks, and that was sort of like good enough. I'd say like when I look at the go to market, a lot of these companies that are 10xing or 20xing are not going to sustain that growth, because fundamentally the improvements and the growth comes from completely liquid markets where whatever's a penny cheaper, you'll just use that. And so they can get all the volume from big players, especially in like emerging markets, in 1 minute, because they're cheaper for that day. But then the next day when somebody else comes in and is cheaper, they'll get all the volume. So there's no like stickiness to the thing. It's just purely I'm cheaper. Sometimes you're cheaper because you're first. Sometimes you're cheaper because you're a regulatory arb. Sometimes you're cheaper because you're fundamentally better. And I think you really have to focus on those ones that are cheaper because they're fundamentally better. And like, this is weird, but I think you need a long-term strategy. You need like a 10-year strategy, and then you need like a 6-month strategy or a 1-month strategy. And I think your 1-month strategy can be completely bad. It can be like a really stupid strategy that gets you to scale quickly. That's like some hack or some regulatory arb or some functional legal gray area, which no one else will do. And then you need a 10-year strategy where you're going to fundamentally add value and create some kind of durable advantage. And I actually think that like the 10-year stuff, everyone has. Like it's really hard, but there's a lot of guys that have it. Combining the 10-year, a lot of the 1-year stuff, the 1-month stuff, a lot of other people have. And it's really hard, but like if you just have that, it's not enough. And I see very few companies with the two.
Yeah, it is interesting. I think that's a great observation. It's almost like what is the growth hack initially, and
Yep.
how does that growth hack mature into a sustainable business? And you see business plans that talk sometimes way too much about the end game,
Yep.
which we can all hypothesize about if you've got any, vision and understanding at the macro level and have followed the trends. And then you see teams that like have an interesting growth hack, but it doesn't scale in any way, or there's no opportunity to add to that. So like combining the two
Really hard.
is
Really
rare,
hard.
right?
For sure. So many of the folks and founders in the audience today, they're thinking about fundraising or they're actively fundraising. I'd love to dive deeper a little into this topic. As investors, what are maybe some of the most common mistakes that you see folks make when they're raising a seed round or a Series A round?
So I mean, I have seen, and we have plenty in our portfolio that I think it was easy to get excited about all the hype that was happening, especially during 2025, and perhaps went out too early, to raise a Series A, um, when clearly, as I was mentioning before, the bar is moved, and a lot of people who are looking at Series A at the stablecoin space are classic fintech investors like Finn here himself, and so they're used to kind of putting like for like assessment along all of the other fintechs they see, and they're not going to necessarily give anyone a free pass because just because they've got stablecoin in their title. So, going out before you've really evidenced that's a sustainable growth and absolute level of ARR, I think was a mistake that I saw from several players, and they got penalized, right? They struggled to raise, the 10, 15, 20 million A rounds that they were looking for, had to do seed extensions instead, which, I think many investors were glad to do because they could see that those target ARRs were achievable, but just not in the sort of 6 month period that, an investor is doing DD on you and making a decision. And so you needed to buy yourself an extra 6, 9, 12 months, whatever it is. So I saw a lot of that. I also saw a lot of, again, because of the kind of hype, there was suddenly a lot of noise. Everyone was doing stable coins of some sort. And it was really interesting to see how a lot of pitch decks were very selective in who they chose to say as their competitors. It's understandable. It's a sales deck, but if you're talking to an investor who kind of has been in the space for a little bit, then chances are that I know those players, and I also know players that you have not put on. And it shows to me that perhaps you don't have an understanding of the space you're in, or that you're trying to hide something. And or so I prefer people to be like really clear, crystal clear around what it is that they're doing that's different. What is the tweak that they're doing that's different, and being very transparent about who they compete with, who they see in the market, and why they're winning, as opposed to trying to hide that on competitive differentiation. Those were two common themes that I saw sort of for the transition phase between seed and Series A. I think there's a bunch of other things we can come to maybe in the next question around how a team can best prepare for the A, but those were two common mistakes.
For sure. The only thing I'd add to that, which I think was a pretty comprehensive answer, and I agree with, is that I think valuations have gotten really crazy, and the amount of money raised has gotten really crazy. I think the actually ironic thing is that like stablecoins, only if I don't to Anil's earlier point, like not that many of them of the startups are gonna end up being that like incredibly valuable because a lot of established financial institutions are going to come in and grab a lot of the market. So you're not talking about like you might be talking about a replace the banks moment, but you're much more likely talking about a banks jumping in and ultimately owning a bunch of the space, or at least other financial institutions. But like the valuations and the amount of money raised, the irony is when you see 10x's and 20x's, you realize you don't need that much money to scale in stablecoin. It is inherently a low friction, high impact kind of technology. And so when you raise a ton of money at really high valuations, and I see people going out and raising A's, A1s, A2s, A3s, just because they can, 10 million, 10 million, 20 million, just because it's hot. I don't think they ask themselves what they're going to do with that money. I do not think this is a money game. I do not think this is a game where if you raise more money at a higher valuation, you win. I think for startups, it's going to be a technology game. Fundamentally, have you built something that's incredibly valuable or not? And I just do not think that you do that better by raising more money than a little bit, or by like having a high valuation initially. I think this is a marathon, not a race for these guys. It feels like a race because they're getting rewarded in the short term, but that's going to go away real quick. And then they're going to just have sold most of their company and be at a high valuation they no longer deserve. And that's pretty deadly. So my recommendation to these guys is always to think more deeply about what they want to build in, that 5 or 10 year time frame we were talking about, and only use the short term money and valuations to get there, and not for its own sake.
Sure. So you guys have referenced this so far. Stablecoins are sexy. The market's becoming increasingly crowded. There's new entrants. It seems like every day I read about a new company trying to do something new or transform an existing use case with stablecoins. At this stage of funding, seed stage businesses, Series A stage businesses, how should teams really think about showing real differentiation and really separating themselves from the pack?
I am shocked by how little a lot of teams know about the payments infrastructure that exists. Like a lot of my diligence is like, okay, guys, like you think you're better? Let's talk about the other thing that you're replacing. And the lack of knowledge, the lack of fine granular knowledge about what they're replacing, the lack of deep competence around payment systems and what they're and it is shocking. Like they think they're going to build this new thing that's just going to work and it's going to be great and it's new. But like, I'm sorry, in fintech in particular, you need to integrate with existing legacy systems. You need to have, there is a lot of regulation. There is a ton of infrastructure already there. And I do look for deep knowledge and competence in payments before I invest. I don't think that the like sui generis stuff is going to work as well. I mean, there'll be a few that work and I'll miss those and Anil can invest in those.
I'll do the ones with you instead. I mean, I largely agree, although I'd like to take a step back because I think for me, there's both in my portfolio, but also in the deal flow that I'm almost seeing a bifurcation of types of opportunities. And I think the entrepreneur has to ask themselves which bucket they're in. So, the first bucket, arguably, you don't need to have as much of that kind of knowledge that Finn was talking about there. You more need you're an on-chain player, and you more need to answer the fundamentally the equally hard questions of why the hell can you do everything on chain? Why do you need a distributed ledger to solve this? What is the reg arbitrage you're doing? Why is it important to do self-custody? What is the advantage about the composability of all this permissionless liquidity, combining yields from wherever, switching between stables, versus doing this in the traditional way, which probably would require years of testing and regulatory work for the fintechs, Web2 fintechs. If you can answer those questions very clearly, you have more of a crypto degen proposition to
Yeah.
offer. And I think that's a different set of skills. Over time, you're still going to be competing for the same sort of customer base, perhaps, but I think there's a period where your execution relies on a different set of skills. If you're in the other bucket, where it's very clear that what you're doing is either serving classic fintechs, banks, fintechs, enabling them to leverage stablecoins, and you play a part in either the virtual bank accounts, the orchestration, the on-chain liquidity, the custody, you name it. Or you're actually trying to build, a replacement to Finn's point. You've really got to understand what it is you're replacing, as is perfectly what you said there, Finn. I mean, you've got to understand where you have or how you get regulated, what the importance of clients. You've got to understand that payments is integrated and embedded into all sorts of different workflows. You've really got to work and understand the importance of banking relationships and redundancy of banking relationships, even if regulation at the 1,000-foot level seems to make it easier. Direct access to banking systems, on and off ramps, importance of credit. I mean, it's the list goes on. And it's a different set of entrepreneurs that I would look for that latter. Yeah.
I mean, I will say, like, to that point, like, I don't do much in the first bucket. So you're the first bucket there of like on-chain stuff is important, and Anil can speak better to that than I can. But I do think there's an opportunity here for some teams to do something like that. I mean, there is a financial inclusion angle here that I think is important and should be mentioned, which is I do think the traditional financial system has left out, not like everybody, but like for a lot of people that either it was too complicated or it was too expensive or it was too onerous or it was too there was too much friction to onboard them and serve them. And I do think that like I really like teams that are doing stuff that couldn't have been done by traditional finance. Like, it's not that they don't need to understand traditional finance, it's that this enables a whole new set of customers and a whole new set of products that weren't possible before. Again, I'm super biased against the stuff where we're like, I'm 1% cheaper, I'm 2% cheaper, I'm one day faster. Like, it's great to be one day faster. I don't think that builds a great business long term. But I do think that like serving a new set of customers and with a new set of products is a winning business, and I think can be either Anil's first bucket or second bucket. That can be on-chain only, or that can be enabling financial institutions to serve new customers. I think that wins in both buckets. Whereas I think the like 1% thing, it was like way harder to build a good business. So I really, want to see teams that aren't trying to be 1% faster. Like I think, or 1% cheaper, or 1% prettier. Like I think that's like there are going to be companies that win doing that. It's not going to be companies I invest in.
Yeah, I think that's a great point. I mean, arguably, that's also why some of the very early success stories came from Latin America, and also we're seeing, Africa, Yellow Card doing their series, has done the Series C, they're on the Series D, expanding globally, and it's just like it doesn't matter that stable coins are an empowering factor for fintechs and banks, classic Web 2 fintechs and banks. Those banks, and in particular, like JP Morgan corresponding banking, they weren't ever in Africa in the first place and never will be. So
Yes, exactly.
doesn't matter if the stable coins make banks more efficient. They're just not there anyway. So they're not
Right.
serving that customer base.
Well, I think you touched on a really hot button topic that Josh, I think Josh may get to later, so I don't mean to jump the queue, Josh, which is
Let's
U.S.
jump.
The U.S. government clearly sees stablecoins as a geopolitical strategy as well as a financial one. Like they're not. Let's not pretend for a moment the Trump administration doesn't understand the ways in which stablecoin centralizes the U.S. dollar in global finance in a new and a really interesting dominant way. Like if you thought the U.S. as a reserve currency was losing some traction after like Russia's invasion of Ukraine and like some of the SWIFT stuff, like the U.S. just reconquered the center stage with stablecoins because stablecoins can be seen as the ultimate undermining of dictatorships, currency controls, friction. The wealthy of the world can now get access to the U.S. dollar without a U.S. bank account, and I think it's very hard to understate the geopolitical importance of that. I don't know how you make money doing that. I don't know if that makes a lot of people a lot of money or not, but like that is clearly a major reason why this is happening and why this is being allowed. And so if you don't take that into consideration, I think you're going to miss some of the ways in which the river flows because the government cares a lot.
So yeah, I guess like expanding on this point, geographically, which regions are you guys most excited about as it relates to I would say like the stablecoin use case, adoption, etc.
Yeah, I mean, obviously, as I mentioned before, we saw some of the early strong movers in Latin America and then even Africa. There's no doubt, however, Finn's point about the US dollar is true, and the larger volumes of stablecoin flows are still in US dollar denominated stables, and so therefore the US
I think it's like
has the largest
99%,
volume.
Anil. I don't think it's
Yeah,
like a larger
yeah.
volume. It's like
Yeah, larger volume.
99% of stablecoins denominated in US.
I was trying to be more international here, but my outlook is definitely that will decline, right? And I think it will just reflect the FX markets we see today. I mean, the US dollar is probably 60 odd percent of trade, but not 99%, and they're certainly lower than that in terms of FX markets. So I think it will reflect that. I mean, all the Asian countries have spent the last 30 years decoupling from the US, working really hard to do that. They're not going to let the sort of backdoor entry to US dependency happen again, despite the amazing power of the Trump administration and the regulation that's happened. I just don't believe it. So, and there's plenty of local use cases for stable coins, whether those are powering real world assets, whether those are geopolitical, like Chinese merchants not wanting to deal with US dollars, et cetera, or even in Colombia, people needing and wanting to work with local stables. So I am more bullish on a more balanced market in terms of a stablecoin choice, and we've invested in multiple local stablecoins. But there's another angle too, which is, I think I fear that even though the US dominates today, that it's also where we've seen the biggest decline in take rates in stablecoin payments, right? Just in the scope of a year, I've seen some of our portcos. The volumes have skyrocketed, but the take rates have halved, right? And this is pretty significant. Whereas in other regions, you can play FX games, and FX is a really attractive margin business. It's not a steady state of guaranteed amount of revenue, but you can play some really interesting revenue games in FX liquidity. I do think that Finn's early point around spotting opportunities, let's say in hyperinflation countries or capital control countries, to give them access to US dollars or hold and yield opportunities for consumers and those will be African and some Latin American plays. That's strong. Like I said, anywhere that's building capital market solutions with real world assets will want local stable coins as the atomic unit. And that's probably where European stablecoins will find the product market fit in capital markets. They won't find it in payments unless it's, as I was saying, a geopolitical decision around wanting to hold euros instead of US dollars. So I think you have to be very particular. And then if you're a player there, you've got to decide which corridors do you want to work in, because every corridor will have a cost and a benefit, right? You can build up defensibility, but that the cost might be on sourcing liquidity or solving for capital controls or solving for regulation locally, which may outweigh the volume that you can get in that corridor. So it's a complicated answer. Sorry for that, but I don't think it's very clear around it's this country or that country. Lots of factors, and depends where in the value chain you play.
Totally. I'll give a slightly historical answer, which is I think Bretton Woods, which sort of centralized the dollar in the U.S. in the global currency system, as a preparation for the Cold War. Really focused on the Middle East, the oil and settling oil transactions in dollars was kind of a big part of it, and that's kind of what forced the world onto the dollar. I think that the thing that the U.S. government cares a lot about vis-a-vis stablecoins is South America. I say that because I think the U.S. is clearly, if you read the Trump administration's most recent policy paper on geopolitical strategy, they spent more time on South America than any other geo, much less time on China than you'd expect, much less time on Russia than you'd expect. It's a military pivot to Asia and an economic pivot to South America. Now, this does not mean great companies. This is not less investor, but you said geos. I think that the stablecoin, the biggest impact on stablecoin will be against governments and places where holding the U.S. dollar is important from an international perspective. And so the two things I'm excited about is intra-U.S. efficiency and speed of transactions. I think that's going to be enormously impactful. And if you read, if you look at Ronald Coase and the Coasean economic stuff, as then applied to Oliver Williamson, both of whom won Nobel Prizes in different years, transaction costs coming down could have radical impacts on not just the cost and speed, but also on the nature of transactions. Imagine a U.S. where there's not 3% drag with Visa, MasterCard. There's not this crazy thing where you can pull money out of my bank account whenever you want without my permission, which is the way we do it. No one would build the U.S. financial system the way we built it. And we now have a once in a generation opportunity to rebuild the U.S. financial system along much more rational and much more less fraudulently vulnerable lines. Because the first one was not built in a thoughtful, systematic way. It was built in much more of a haphazard, historical way. And I think this is a once in a generation opportunity to rebuild the U.S. financial system in a logical way. And that's a huge opportunity, in my opinion, the biggest. The second biggest, I think, is South America. And I say that just because I think the U.S. wants to and needs to dollarize South America as a way to undermine the government's ability to control and extract from its population. I think the U.S. will use stablecoins as a geopolitical tool to reduce the power of totalitarian dictatorships and laws and regulations in other countries. And I think it cares most about South America. So I'd say Brazil, Colombia, Venezuela, Argentina. These are going to be enormously huge opportunities. I think you have the backing of the U.S. government.
Thanks, guys. So maybe pivoting quickly, if you think about, let's say, collaboration versus competition in this market, it often, to me, it feels like a Venn diagram. There's companies that are partners in some areas, they're competitors in other areas. How should a scaling business within the stablecoin ecosystem think about navigating this dynamic? Do you think there's multiple players that could thrive, or do you think naturally over time the market will continue to consolidate?
Well, we've already seen a fair bit of consolidation. I mean, Stripe is probably the most aggressive, but it's very clear that those maybe tech-focused payment companies, the Stripes, the PayPals, even the Visas and Mastercards will acquire to solve what are some quite challenging on-chain problems, whether that's managing cross-chain swaps, on-chain liquidity, transaction monitoring, compliance, optimizing card acceptance for on-ramping, for high risk, vaults with DeFi, MPC custody, managing a double spend problem between acceptance and settlement for card networks when you're dealing with self-custody wallets. All these sort of nitty-gritty challenges, I think those are acquisition targets, right? And yeah, the challenge then will be, are those 50, 100 million dollar acquisition targets, or can you build a bigger business before to get sort of nice outcomes? So I think we've already seen that. I think there will be, as I mentioned before, stablecoins will enable banks, but banks don't necessarily have the DNA. So they will, and they're not really acquiring businesses per se, but they will partner then. They'll partner with storage companies, on-ramping companies, security, DeFi yield, compliance, on-chain compliance. Banks don't know how to do that. But they have all of the kind of trust, credit, connectivity to liquidity, Fed rails, so that the combination is a good one, but probably more partnership than acquisition. And then I've also seen some interesting dynamics appear now when there are sort of stablecoin infrastructure companies that enable fintechs to do orchestration or to do XYZ. There's a lot of them that were point solutions and they were solving something quite niche, and now the fintechs are asking them, yeah, but I don't want just a card associated with my on-chain wallet. I want you to give me a virtual bank account. I want you to give me on and off ramps. I want you to give me yield. And so the question for those point solutions are, do you stay point and deep and maybe that limits your valuation in an exit, or do you try and broaden yourself across multiple touch points? You've seen this with Rain cards recently. They raised a good bit of money. They were card focused. Now they're doing a whole bunch of things because their customers have asked them to do that. So that could be through acquisition that they do that. It could be organically that they expand, but certainly they're going for more fully packaged solutions. So I've seen that dynamic too. In other areas of the value chain, I think there will be a huge amount of commoditization, on and off ramping, with the margins declining in the kind of big stablecoin swaps, even wallet infrastructure to a certain degree. So then the question is, does that commoditization then lead to the need to get volume scale through consolidation?
I don't think of the world exactly in this way, so I think Anil's answer on this, I have nothing to add.
All right, thanks. So maybe transitioning more to investor selection for these businesses who are thinking about raising money. I'd say seed, Series A stage type businesses. Which investors do you guys think adds the most value? You think it's a crypto native VC, strategic partner, corporate venture arm, a global fintech investor? Any thoughts there?
I mean, you're presupposing that an investor adds value at all, which you have to convince me of. And I'm kidding. Of course, we add value. Um, but no, I mean, I think it's more partners. I think this is generally true. It's just more partner specific. I think you find someone you really like working with, and you like the way they think, and they want to support you long term, and they have a position in the organization that's lasting. Like maybe don't choose an associate, to like peg your hopes on. But like if you have a serious person, organization who's willing to back you long term, I would be more partner specific. We're fintech specialists, so I think we do add some value being fintech specialists. Anil is a crypto sort of blockchain specialist, so I'm sure, and stablecoin specialist, so I'm sure he adds a ton of value in that specifics. But if you find a partner you love, I think that's what you should go for. That's my personal opinion. I do think the specialization that we provide adds some value too, but I think it's secondary to the partner.
Yeah, that's a great answer. I mean, it's a relationship for a long period of time, hopefully, right? And you want someone to challenge you as well as support you. It is a very personal relationship. Yeah, the firm can matter from a brand and obviously capital, but ultimately it's the person. Have I got anything else to add to that? I mean, maybe going back to how I sort of bifurcated the world, what kind of company are you? Are you this on-chain play, or are you, someone that is building to serve fintechs or replacing
Yeah, yeah. Maybe for
fintechs?
the
That
on-chain plays, some additional specialization helps. You're right. Yeah,
yeah, you might decide, but I would
yeah,
concur 100% that a large number of companies that I see, they are dealing with payments in the traditional way, or their client bases, payment company or a bank or something. They would have a huge amount of value from like a classic fintech fund. You just got to choose the right stage. So is that necessary at pre-seed or seed? It becomes more important, I think, at A, when you're trying to open up relationships and sales are scaling, to have someone like Finn on your cap table. I would think that is a
yeah,
no-brainer.
yeah.
The other angle, because I've spent a number of years at corporates, that I often get asked about. And by the way, not every corporate VC is the same, and you have to be very careful. Some are, doing it for PR, some are doing it for biz dev, and some are doing it generally for profit. And I think if they can be valuable, you really want to be careful they don't lead the round per se, and it's priced by a corporate. So certainly those that are more strategic versus for profit. But if you're going to do something with a corporate, you can actually do more of a strategic round where you engage with them with, let's say, warrants, where they actually deliver value to you and earn their right to be on your cap table in a smaller way, through delivering value. But I, had the luck of working with PayPal Ventures, who are a more for profit investor, and so those guys are absolutely great to lead or co-lead rounds with too.
Yeah, look, I think that entrepreneurs are by definition focused on a very narrow niche of what they're doing because they're doing something very specific. Some entrepreneurs have a broader vision as well. I mean, they have a vision of what they see, obviously, in the system, but they are by definition. I think VCs have potentially the best VCs, and there's the few best VCs have a broader perspective because they see so many companies in so many spaces and can provide some kind of general guidance on maybe some guidance on strategy. But I would say that there aren't that many VCs that are actually bought in on blockchain and stablecoin and crypto. There are a lot more who think it's a hot space and they want to get their bet in it. And to Anil's point, if you are really doing something super geeky in stablecoin, you might benefit from somebody who shares your vision and isn't just trying to get their play.
Yeah, let's say the best answer is having both parties represented, right? I mean, it's even on the fintech side. I mean, soon it will be the case where, most of Wynn's deals you look at, you may look at a remittance company or something like that, and that would have been a classic fintech play. But actually, that fintech, if they're doing things right, should be leveraging stablecoins at
Yes.
some part of their
Yeah.
business, and then really understanding, how are they using stablecoins? Are they appropriately regulated for that? Do they have the right risk controls for that? Where do they get the liquidity? There might be a ton of questions where someone who spends most of their time on chain can complement the classic fintech view. So I see emerging. These companies are all merging, and I think you need a blend of skills on the board to help you navigate that.
Thanks, guys. So a few questions we're getting in the chat. I see there's a question around the best way to get in touch with Anil and Finn. Good question. The decks that you guys submitted in the Luma when you signed up, we're actually going to be forwarding them over to Anil and Finn, and then so that hopefully answers that. It looks like there's also a question from Felipe. Which types of business models with stables have you seen that do not require volumes to scale monetization? Good question.
Volume is good.
Not
Volume is
required.
good, guys. Volume is good. Let's not insult volume.
Yeah,
Volume suggests
curious why
demand,
you
right?
wouldn't want volume.
Like, I guess if you have high
I mean,
margins, you can do it with less volume. But I think Anil's point before is the best one, which is, do margins collapse as you increase volume? Like, is like you double your volume, but you have your margins is not a great strategy. So like, where are there durable margins? I think is the better question than where can you get volume, because volume without margins doesn't mean anything, and margin without volume doesn't mean anything. So you really want like a reasonable amount of reasonable amount of volume with great margins. I take all day long, every day, over any other combination.
yeah, and maybe there's a different perspective here, which is, I mean, so clearly if you're in the B2B game, it's not your volumes directly, it's your customers' volumes, but nonetheless, there's an indirect implication on the adoption of your technology. If they have good volumes, they're most likely to issue more cards or something like that. So whether it's direct or indirect, I think Finn's correct on that. But maybe there's a different way to look at this, which is something that Finn and I have probably seen a lot in the classic fintech investing space, certainly from my days at PayPal and before, is where payments is actually just a loss leader. So you kind of accept that it is something that has almost negligible take rates associated with it, but it's incredibly sticky for the customer relationship, and you have these sort of perpendicular methods of making money. I alluded to it a bit before with FX, but within embedded payments in SaaS, you could clearly have maybe a payroll company doing payments. That's the payment aspect is probably not where they're making the huge amount of money. It's more the SaaS fees. So think about like especially with smart contract based payments, or where the movement of money is not just a dollar, but there's logic that flows with it. There's workflow that can be automated or embedded in these types of movement of money, and that actually we might have solutions that are maybe less about the transfer of money and more about what is the workflow you're solving because of that movement of money.
And it looks like another question, and we only have 5 minutes here, so if anyone has anything else they want us to cover before we hop off, just let us know. A question here. I agree that a lot of the infra out there, ramps, chains, FX, etc., is starting to commoditize. Where does the value accrue for on-chain companies when that happens? Would love your takes.
I think maybe we answered a bit with my prior point, and like maybe there's some examples of that. So one of the best analogies is, of course, a company like Deal that separated the notion of employee of record from the payroll, right? The separation of state. In the same way, both Finn and I have seen many merchant of record plays, right? Arguably, where you kind of separate out somebody selling the goods from all of the kind of workflow stuff that needs to happen, whether that's the accounting, tax, VAT, offering all the different types of flexible payment methods, subscriptions, all that kind of stuff. And so if you separate those ways out, then like you're not so much solving a movement of money, you're solving a complex problem around the movement of money. So we haven't seen that so much yet on chain, but that's probably one of the areas that I'm most excited about, mid-term, which is leveraging really smart contract logic in the movement.
I think there's a B2C and B2B version here of the answer, which is like, I think B2C tends towards big winners with low margins. And so like scale matters a lot, and you get these like dropping margins, but then you're the top player. Very hard to maintain margins in B2C. I think there's economies of scale there, and like economies of like, regulatory arb. But I think B2B, I think, is much less sensitive to margins. If you're worried about commoditization, all that stuff, I think you can get some great B2B relationships, do great service, deliver a great product at a reasonable cost, and you can stay in business for a really long time. I don't think businesses are as focused on margins as consumers. So I think B2B would probably be the best way to avoid that commoditization. If you're great B2B and you have a bunch of good relationships, they're not changing you out for one penny.
All right, thanks, guys. I think this brings us to the end here with only
Pleasure.
2 minutes until
Thank you.
12. So yeah, before we wrap up here, just want to thank everyone for joining today. We appreciate everyone taking the time to be here, and also, of course, huge thanks to Anil and Finn for taking the time, for sharing their insights, their perspectives. Hopefully, everyone came away with at least one actionable item from the conversation here. This is the second of multiple webinar series that's going to be run by Utila, so please keep an eye out for more episodes in the future. And yeah, that's all we got today. Thanks again for joining, and feel free to get in touch with any additional questions or anything else.
Thank you, Josh, for moderating, and anyone on the audience who wants to chat with me or with me, please drop me an email.
Awesome. Yeah.
My email is finn@haymaker.com, and I think the other information is already in the packet that Josh sent out.
Yeah, likewise. Thanks for having me. Anil at fabric.vc is my email, or on LinkedIn for ease of access. But yeah, happy to chat.
It's Finn with an N for the chat, not Phil, but I'm sure they'll both work. Thank you.